right, welcome back, traders and investors. You're coming back to Benzinga's pre-market prep show. My name is Garrett Cook. I'm here with Brianna, and I've got a few questions for the one and only Dr. Mikhail Melnik. Mikhail, how you doing? Welcome to the show.
Well, thank you. How are you?
I'm doing very well. I got a few rapid-fire questions I feel like hitting you off with. We got a bunch of things going on, mostly in Europe, and then I would like to get some viewpoints on the Fed if possible. So let's start first with what's going on over in Greece with these elections that they have and the potential for systemic mentality risk over in the EU, given the fact that they're going to try to perhaps restructure some of their austerity measures. What do you think this impact would be on the EU if Greece is actually able to do this? Do you see France and Spain following suit, or any other problems coming along if they seem to renegotiate their austerity?
I think you correctly answered the question already. If Greece is allowed to do this, then some other countries will follow suit. So, absolutely, it will create a precedent. And if one is forgiven, then why not another, right? And I think everybody anticipated the outcome of the Greek elections. Even though there was some pressure put on Greece by Germany, political pressure, at least it was seen out there, trying sort of to influence the outcome, but I think the outcome was expected, and I think the central bank of ECB acted sort of preemptively in a way, and perhaps even set the stage for this. I also was surprised to see some commentaries out in the media kind of viewing this from the perspective of even a more systemic change. In other words, should Greece be sort of pushed out of the European Union? Should there be a discussion of reviewing kind of the membership of some of these states? And my personal opinion is that there's absolutely no incentive for Greece to leave the European Union. And I think that what you're seeing there is just sort of a struggle to reduce the debt burden of Greece, and that's what the Greek voters voted for. If I were to, and I might be crazy here, but if I were to say if there's any country that should step outside of the Union or leave the Union, it should be Germany itself. Because in the long run, the Union is starting to cost more to their economy, or at least the outlook will be of greater cost to their economy than the benefit.
And I fully agree there, too. I think that they've got to, if Germany's going to be doing so well, they're going to have to get out in order to save these younger guys. The mismatch there is just too great. So then going forward with the Fed action that we had yesterday and the discussions that they're going to open up reverse repurchase agreements, personally I'm looking for them to open up FX swaps again, because I don't know what the ECB is going to be able to do going forward if there is this mentality risk over in Europe right now. So do you potentially see another example of where the Fed is going to have to come in, potentially want to raise rates to perhaps have more weaponry should they need to come out and do some monetary policy going forward? That they potentially try to raise rates in order to help the ECB right now, such as what we did back in 2000, 9 to 11 when we were doing direct loans to, the banks over in the ECB while doing FX swaps with the ECB in the short term? I mean, do you see the Fed coming in to basically assist?
But in 2009 we didn't raise the rates.
Correct.
So we in essence offered more of direct funding rather than raising rates, and I don't think there is any need for that at this point in time. And remember, the debt of Greece is actually in euros, so if there is a restructuring to be done, it's sort of within the European Union. But frankly speaking, I don't see much of an impact Greece trouble if it even materializes, because personally, again, I think the status quo in Europe will sort of continue. In other words, there will be a further restructuring of Greek debt, some restructuring. There will be a lot of discussion in the media, but that's about as far as it will get. I don't expect any major storm coming out of these elections or anything else. The European problems are much more serious than Greece. I think we discussed it back many years ago in our class. We can talk about Greece, but then there is France, whose economy is also lagging and whose national debt is also rising. So the problems of the European Union are much more fundamental. In terms of the Fed's actions and in terms of the Fed's decision recently, and what can the Fed do? The Fed has been extremely accommodating. The Fed has not only been accommodating to our own economy, but also, if you mentioned it correctly, in 2009, 2010, to the European banks as well. I think that will come back a little bit. But in terms of our own outlook, you mentioned the rate rise. Again, I may be a little bit out on a limb here, but I personally think that the probability the Fed will enter another quantitative easing is greater than the probability the Fed will raise rates this
That's
year.
not what I wanted to hear. You're supposed to agree with me and say they're going to raise rates mid-year.
Well, as I always argued, this process of money printing will continue for quite some time. Realize the problems we have, again, the U.S., I got to give you credit here. Remember the last time I was on your show, you said I was a little bit too optimistic. I said we'll have a decent year, right, going into 2015, and you mentioned that there is sort of a forwarding of demand, right? And if you look at the recent durable goods orders, well, it seems that your argument was correct, right? So we've seen sort of a meltdown in not just durable goods orders per se, but more importantly in factory equipment. We're still seeing soft growth in non-residential structures. And look, all of this is also accompanied by rising crude inventories. All of this tells me that the U.S. economy is slowing down. Now, I still believe there is no recession. I still believe 2015 is a decent year. But the growth rate gets slow. You know, the outlook for growth is closer now to 2 to 2.5% instead of 2.5% to 3% range. So with this growth, can the Fed afford a rate rise? And for what? To help the dollar get even stronger against, say, the euro? No. And the weaker euro is not much help to the European Union. If you look at Germany, right, which is the engine of the European economy, it's an export-oriented economy in essence. It's not like China, but it's still an export-oriented economy. But most of that export is within the European Union. In other words, the trade is internal. A weaker euro offers very little stimulus. If you look at our trade with the European Union, for example, our exports to the European Union are equivalent, roughly speaking, to our exports to Canada. And Canada only has 34 million people, while the EU has over 400. So a weaker euro, a stronger dollar, how much will that help? I'm not so sure. So the European Central Bank embarked on a forced program. They were printing money that will help lower the cost of borrowing money to European governments, which are already heavily in debt. In essence, we've done the same thing here in the United States, and that has helped financing of our own treasury. So that's understandable. Giving banks more liquidity is also helpful. That's understandable. But a weaker euro, I'm not sure. This is not Japan that tries to weaken its yen and outcompete other competitors in the U.S. market. Here, the story is a little bit different. And from the U.S. Economic perspective, I think we're going to grow this year, but the growth is not going to be robust enough to worry about any rate increase. And I think if you read the message the Fed posted on their website, the statement, right, that statement is very, very cautious. It sort of sets the tone for any direction depending on the data. And the data doesn't seem to be extremely strong. So this is something that I don't understand from the stock market's perspective, because if you look at the market's reaction, the market is very nervous right now, right? VIX is rising. VIX jumped again above 20 yesterday, especially after the Fed's announcement. And yet, I don't know what the stock market fears. If it fears the economy falling short of the expectations, that fear is valid. If it fears the Fed prematurely raising rates during the summer quarter of this year, then I think that fear is not founded. And I'm not the only economist who makes that statement. If I mentioned it on your show back in October that the Fed will remain accommodating throughout 2015. In fact, also throughout 2016, it's likely to remain accommodating. But even people like Paul Krugman, who argue for more monetary measures, also notice the same behavior. I remember seeing him on one of the television shows, and I think he mentioned something similar. So I think most economists seem to be more comfortable with the Fed's message than the market. And I don't know if that's a problem on the Fed's communication side or whatever, but the market seems to seems to worry about the Fed a bit more than most economists out there.
All right. Well, thank you, Professor. We'll wrap it up there. So it looks like you are seeing no recession but slower growth going forward, and that kind of jives with some of the changes.
Let me wrap on something else.
Go ahead. I'll give you a minute.
Have me around the major holiday. And I tried to figure out what holiday was coming. And Ronald Reagan's birthday is coming. I know that because it coincides with my own. And I think we should look back at the 80s. Ronald Reagan, when he began his presidency, he simplified the tax reform. He did it in '83. He made the significant foundation work in the area of supply-side economics in the United States. And I think that's what governments need to look at today, because we seem to be working on the demand side. We seem to create this sort of confusion for the business sector, and the business confidence is lagging because we overtax it, we overburden it. That's where we need to look at. February 6th is coming. We should probably look at Reaganomics and revisit it.
Okay, excellent. Well, thank you for your time, Professor. Great insight, and we will have to revisit again shortly and see what happens with the Fed funds rate here. So again, guys, that was Dr. Mikhail Melnik. Mikhail, I appreciate you coming by. Thank you very much. Let's swing over to Brianna for some updates, some commentary. What do you got for us, Bri?
Thanks a lot, Dr. Melnik.